The Relentless Pragmatist, Lessons from the Life and Times of Jim Slater. Well, good morning. It's a privilege to be with you all today to talk about a subject that never gets old. At least for folks like us, the pursuit of sensible investing. You know, in this business, we meet all kinds. There are the speculators, the chart watchers, the story believers, and then, every once in a while, you come across a true craftsman. A person who treats investing not as a gamble, but as a business of its own, with its own set of tools and blueprints. Today, I want to talk about one such craftsman, a gentleman from Britain by the name of Jim Slater. His story is a powerful one, not just because of the money he made, but because of the journey he took. It's a story in 3 acts, a spectacular rise, a humbling fall, and a thoughtful, disciplined redemption. And in that redemption lies the real lesson for every one of us, whether you're a stock picker, an index fund investor, or just someone trying to make sense of where to put your savings. Act 1, the prodigy and his formula. In the swinging 60s, while many were caught up in the mood of the moment, Jim Slater was building something remarkable. He co-founded an entity called Slater Walker Securities. Now, this wasn't your typical investment fund. It was an agile, aggressive creature, part investment vehicle, part corporate surgeon. The model was straightforward in theory, but brilliant in execution. Identify undervalued companies, often ones that were poorly understood or simply neglected by the wider market. Take a significant position, and then actively work to unlock that buried value. Slater possessed a mind that was a natural calculator. He could look at a balance sheet and see the story it was trying to hide. He had an intuitive grasp for the numbers that truly mattered. His firm would often streamline operations, sell off non-core assets, or engineer mergers. It was a hands-on approach to creating wealth, and for a time, it was wildly successful. The market, as it often does, fell in love with a good story and a rising price. Slater Walker's shares soared, and its founder became a celebrated figure, a symbol of a new, modern financial savvy. But here's the crucial thing to understand about this early period. Even then, Slater wasn't just shooting from the hip. He was developing a system. He understood that in the large, well-trodden fields of big corporations, it was hard to find a bargain that everyone else had missed. So, he went hunting where others weren't looking, in the smaller, more obscure corners of the market. He realized that a small company, if it had the right engine, could grow much faster than a giant. A sapling can double in size far quicker than an oak tree. This focus on smaller companies was his first great insight. His method during this era was less about a gentle buy and hold and more about what he termed asset stripping. This sounds harsh, but in principle, it was about financial efficiency. He looked for companies where the sum of the parts was greater than the whole. Imagine a company trading for a market value of $10 million. But if you were to calmly sell off its factory, its real estate, and its inventory in an orderly fashion, you could realize $15 million. That $5 million difference was what he called the asset situation. It was value lying dormant, waiting for someone with the clarity and will to unlock it. He was, in essence, a catalyst. He forced the market to recognize the true underlying value that conservative management or sheer inertia had left buried. This approach made him a fortune, but it also made him controversial. He was seen as a predator, dismantling Britain's industrial heritage for a quick profit. But from a purely financial perspective, he was a master of reading the story told by the numbers, a story that many company managers themselves were unwilling or unable to read. Act 2, the storm and the lesson in leverage. Now, no success story is without its trials, and the true measure of an investor isn't how they handle success, but how they navigate failure. The go-go years of the early 70s came to a screeching halt with the 1973 oil crisis and a brutal bear market. The very engine of Slater Walker's success, its aggressive, acquisitive nature and its reliance on borrowed money, became its Achilles heel. You see, in the heady days of a bull market, it's easy to use leveraged borrowed money to amplify your gains. It feels like a superpower, You put down $1 of your own and borrow 4 more. If your investment goes up 20%, you haven't made 20 cents on your dollar, you've made $1 or 100% return on your own capital. It's intoxicating. But when the tide goes out, as it always does, you discover who's been swimming without trunks. Leverage is a two-edged sword. It magnifies losses just as efficiently as it does profits. If that same investment falls 20%, you've not just lost 20 cents, you've lost your entire dollar, and now you owe money. The complex, interlinked financial structure that Slater had built, so formidable on the way up, became fragile on the way down. The economic environment turned sour. Asset values fell. Liquidity dried up. And the house of cards, as it sometimes does in such conditions, collapsed. Slater Walker fell apart. Jim Slater lost a fortune. In the eyes of the public and the press, he went from hero to zero. This is a pain that every investor fears, and few have experienced on such a public scale. It was a very expensive education, but an education nonetheless. Many people would have been finished. They would have retreated, embittered, and spent the rest of their days lamenting their bad luck. But this is where Jim Slater's story transitions from a cautionary tale to a masterclass in intellectual resilience. He didn't blame the market. He didn't curse his luck. He went away, licked his wounds, and did the most important thing an investor can do, he thought. He refined his philosophy. He stripped away the complexity and the leverage and got down to the bedrock principles of what made a great investment. He moved from being a financial engineer to a philosopher of growth. Act 3, the Phoenix and the Power of a Simple System. This was his rebirth, not as a corporate raider, but as a writer and a private investor. And this, ladies and gentlemen, is where we find the pure, unadulterated gold. He detailed his refined philosophy in his wonderful book, The Zulu Principle. The title came from a conversation with his son, who remarked that if you wanted to become the world's expert on something, you could start by learning everything there is to know about a focused subject, like the Zulu people, rather than trying to know a little about everything. Applied to investing, it meant developing a deep, systematic expertise in finding a specific kind of wonderful company. Don't try to be a dilettante in 1,000 stocks. Become a true expert in one promising area, master it, and then move to the next. Out of this period came his single greatest contribution to investment thinking. Now, many people look at the P/E ratio. That's the price to earnings ratio. It's a useful first glance, like kicking a tire. But a low P/E ratio can be a trap, a siren song for the unwary value investor. It might be low because the company's growth has stalled, or worse, it's in decline. A company with a PPE of 8 might look cheap, but if it's not growing, it's what we call a value trap. You think you're buying $1 for 50 cents, but it turns out to be $1 that's slowly turning into dust in your hand. Slater's genius was to add a crucial second variable, growth. He created a measure that compares the price of a stock to its earnings, growth rate. Let's break it down simply. You take the price to earnings ratio. Then you divide it by the company's percentage earnings growth rate. So the formula is the P/E ratio divided by the annual earnings growth percentage. His beautiful, simple rule was this: a company is attractive if the result of this calculation is less than 1. Let me give you an example. If a company has a P/E of 15, the lazy observer might think it's fairly priced or even a bit expensive. But if that company is growing its earnings at 20% per year, you do the calculation. 15 divided by 20 equals 0.75. That's a bargain. You're paying less than 1 unit of price for each unit of growth. Conversely, a company with a P/E of 30 growing at 15% has a result of 2.0, which is expensive. You're paying a significant premium for that growth. The market has already recognized the potential and baked it into the price. This was a revolutionary way of thinking about value. It wasn't just about cheapness. It was about growth at a reasonable price. He was looking for the sweet spot, the company that was both dynamic and undervalued by the market. He was searching for a racehorse that you could buy for the price of a plow horse. But Slater, having learned from his past, didn't stop there. He developed a whole checklist, a pilot's pre-flight routine for buying a stock. This was his defense against the overconfidence and oversight that had contributed to his earlier downfall. He looked for strong, consistent growth in earnings per share. This was non-negotiable. He wanted to see a record of at least 15% growth per annum over several years, and a likelihood of it continuing. He wasn't interested in one-hit wonders or turnaround stories that were long on promise and short on delivery. A positive catalyst, he called it a story. Was there a new product, a new management team, a change in the industry, or a legal change that could propel the company forward? There had to be a reason the growth was likely to continue, a tailwind that the market was underestimating. Strong cash flow. Earnings are an opinion, subject to accounting interpretations and assumptions. But cash is a fact. He wanted companies that were generating real, honest-to-goodness cash, not just accounting profits. A company could be profitable on paper, but still go bankrupt if it doesn't have the cash to pay its bills. A healthy balance sheet. He'd learned his lesson about debt the hard way. He now favored companies with little or no debt, which made them resilient in tough times. A debt-free company can survive a recession. A highly leveraged one might not. He was looking for endurance as much as for speed. Relative strength, this was a nuanced point. While he was a fundamental analyst at heart, he respected the market's vote. He liked to see a company's share price performing well relative to the overall market. His famous saying was, if a share looks dear, it probably is. If it looks cheap, it probably is. He understood that the market's perception, while often irrational in the short term, could be a powerful tailwind. He didn't want to be early and have to wait for years for the market to agree with his assessment. He wanted the market to already be showing a flicker of recognition. Armed with this disciplined, systematic approach, and starting with a relatively modest stake, Jim Slater quietly began to rebuild his fortune. It's reported that he turned a few tens of thousands of pounds into several million over the subsequent years. Not through financial engineering or leverage, but through the relentless, patient application of his simple, powerful rules. This second fortune was built on a rock-solid foundation of business fundamentals, not financial sand. The Index Investor's Guide to the Slater Philosophy. Now, I can hear some of you thinking, this is all well and good, but I'm an index fund investor. I believe in buying the whole haystack, not looking for the needle. How does Jim Slater's philosophy help me? This is an excellent question. You are following a wise and proven path. But understanding Slater's principles can make you a much smarter index investor. You see, an index fund isn't a monolithic black box. It's a collection of individual companies, each with its own story, its own growth prospects, and its own valuation. By understanding what drives the performance of the components, you can make better decisions about which haystacks to buy. Understanding the engine of your returns. When you buy a broad index fund like the S&P 500, you are essentially buying a portfolio where the price is the average PE and the growth is the average earnings growth of 500 companies. Over the very long term, the return of that index will approximate its total earnings growth plus its dividend yield. Slater's method teaches you to think about the price you are paying for that entire bundle of growth. Is the market's overall PE ratio of 20 justified by the overall earnings growth of 5%? That would mean the result of his calculation is 20 divided by 5, which is 4, which by Slater's standard is very expensive. This doesn't mean you should sell everything, but it tells you that future returns from that point might be muted. It encourages a mindset of periodic investing rather than market timing. When the market's overall valuation is high relative to its growth, you might be more cautious with new lump sums. When it's low, as it was in the depths of 2009, you can be more aggressive. You're using his principle to assess the market's temperature. Choosing between haystacks. Not all index funds are created equal. Let's say you've decided on a 60-40 stock bond split for your portfolio. Within the stock portion, you have choices. You can buy a total world stock index, a S&P 500 index, a small cap value index, or an emerging markets index. Slater's philosophy can guide this choice. The small cap edge. Remember Slater's love for smaller companies? A small cap index fund is a way to capture that same dynamic without having to pick individual winners. Historically, small cap stocks have higher growth potential than large caps, just as Slater identified. By allocating a portion of your portfolio to a small cap index, you are tilting your haystack towards the part of the market Slater would have loved. The growth versus value decision. A growth index fund is full of companies with high growth rates, but also high PE ratios, which often means a high result on Slater's calculation. A value index fund is full of companies with lower PPE ratios, but often slower growth, and some may be value traps. A core Slater principle would suggest being wary of the expensive growth index and looking for a value fund that contains companies which are not just cheap, but also have some modicum of growth, a more reasonable result on his growth to price calculation. This is the essence of a blend fund, or what is sometimes called a growth at a reasonable price strategy, implemented via an index. The checklist as a behavioral guardrail, perhaps the most valuable application for the index investor, is behavioral. Slater's entire system was designed to remove emotion. Your index fund strategy is the same. When the market is crashing and your statement is bleeding red, your gut will tell you to sell. But if you understand that market downturns or when the long-term growth-to-price ratio of the market becomes more attractive, your Slater-informed brain can overrule your panic gut. You see a sale, not a catastrophe. Conversely, during a manic bull market, when everyone is a genius and your neighbor is telling you about his latest moonshot, your Slater-informed brain will see the soaring valuations and recognize the danger. It will give you the discipline to stay the course, rebalance, and take some money off the table, even when it feels wrong to do so. It turns you from a passive participant into a strategic, unemotional allocator of capital. The timeless lessons for us. So what can we, as students of the market, take from the life and times of Jim Slater? The system is your salvation. Slater's greatest success came not from his initial flashy rise, but from his later methodical approach. Emotion is the enemy of the good investor. A system, a checklist, a set of unemotional criteria that is your anchor in a stormy market. It keeps you from getting swept away by greed on the way up and by fear on the way down. Whether your system is stock picking or dollar cost averaging into a carefully selected set of index funds, the principle is the same. Discipline trumps emotion. Understand what you're paying for. This growth to price calculation is a timeless tool. It forces you to connect the price you pay with the growth you expect to receive. Never look at a PE ratio in isolation again. Always ask, what growth am I getting for this price? Apply this to individual stocks, if you pick them, and to the overall market and specific sectors when you choose your index funds. The power of the small and obscure. You don't have to find the next mega cap winner. Some of the greatest opportunities lie in small companies that are too small for the big institutional funds to bother with. This is where the diligent individual investor can still have a real edge, either through direct stock picking or by a strategic overweight to a small cap index in their portfolio. Respect risk, especially leverage. Slater's story is a classic textbook case of the dangers of too much debt. Use leverage like you would handle a live wire, with extreme caution, if at all. It's not a tool for the prudent long-term investor. For the index investor, this translates to avoiding leveraged ETFs and margin debt. Let compounding do the heavy lifting over time. You don't need to turbocharge it with borrowed money. Intellectual resilience is everything. You will be wrong. You will have losing investments. The market will humiliate your best ideas from time to time. The question is, what will you do then? Will you give up, or will you learn, adapt, and refine your process? Jim Slater's legacy isn't just the fortune he built twice. It's his unwavering commitment to the craft of investing itself. He fell down 7 times and got up 8. In the end, Jim Slater's journey teaches us that investing success isn't about being a star for a season. It's about being a student for a lifetime. It's about having the humility to learn from your mistakes and the discipline to stick with a sound process through all the market's moods. He showed us that the most powerful investment philosophy isn't the most complex one. It's the one that is so logical and simple that you can follow it consistently for decades, whether you're applying it to individual shares or to the construction of a robust, intelligent portfolio of index funds. That's a lesson worth its weight in gold. I hope these lessons from Jim Slater serve you well in your own investing journey. Thank you.